Even on terrific days like today, the market's too expensive. The averages are dangerously elevated. Just you wait. You'll see how ugly this thing can get. We went up on nothing. We'll go down hard on everything. Sure, I got the litany. I mean, blah, blah, blah. But the more I think about certain calls, certain stocks, certain valuations, the more I recognize that we really have to stop relying so much on the idea of the market. Because the valuation for many big capitalization stocks just aren't that expensive here. Or to put it another way, there's Amazon. There's Netflix, downgraded today by UBS and a rare bit of discord among the analysts. And there's pretty much everything else. I think these two and the endlessly talked about Tesla are obscuring what's really going on here. Notice, first of all, I didn't say FANG is obscuring the valuations. That would be wrong, because the 3 and 5 of those are fairly inexpensive when you look at it. I mean, it was easy to see how Facebook could fall off a cliff if people actually were worried about privacy when they're seeking to promote themselves online. Kind of oxymoronic when you think about it. I mean, why not? The media had a field day with this privacy stuff, and they're probably not even done having that field day. Just yesterday, on a day when tariffs dominated the news correctly, the business section of the New York Times harped on Facebook being fined $660,000, the largest fine that some agency none of us really care about could slap on them. I mean, hello, you could steal $660,000 from Mark Zuckerberg, and he wouldn't even notice it's gone. The fact is, Facebook sells for just 22 times next year's earnings estimates, and at the end of the day, that's really all that matters. The only thing that the investigation has done is shrink the stock's price to earnings multiple, not the earnings, but what will people pay for those earnings, which is another way of saying the stock's cheaper than it deserves to be. Same goes for Alphabet. The possibility of government regulation plus the opaque nature of all the other businesses aside from core Google makes the company hard to value. Meanwhile, we've decided that all we care about is how much it costs Google to get clicks, not how lucrative it is across the board. That's why the stock trades at just 26 times next year's earnings estimates. But wait a second. Maybe we should figure out what it sells for, excluding the $101 billion in cash in its balance sheet. We're like 23 times earnings when you look at it like that. Apple sells at merely 14 times next fiscal year's earnings. That was fine when the company's a pure cell phone story with a PC and tablet kicker. But the Apple we all know now is the subscription play that we pay money to every month, just like we do with Netflix, with Spotify, with Costco, with the Amazon. That's a sticky revenue stream, one we'll probably never kick. 14 times earnings for Apple is now outrageous because of that, outrageously wrong, especially given the company's nearly $300 billion cash hoard. Back out the cash, and it's more like 10 times earnings. It's not just FANG. This morning, Goldman Sachs upgrades J&J from a sell to a hold. When I saw where the stock was trading, 15 times next year's earnings, I was shocked. This is a premier American company with the best balance sheet in the world and amazing management. J&J was ordered by a St. Louis jury tonight to pay at least $550 million in damages to women who claim that the company's talc product caused ovarian cancer. For many companies, this could be way too much to bear. It might not even matter to this fortress balance sheet enterprise. You see Disney at 15 times earnings? I mean, that's what you get because of cord-cutting worries. But what if they buy Fox? Better story. We're at a strange time, people. The vast majority of commentators seem to think the market is ridiculously expensive. To me, the only way the market's truly expensive is if you believe that 2019 is going to be a nasty, horrendous year where there's a full stop to all businesses a la the Great Recession from a decade ago, and all these estimates are too high, all of them, and they have to be cut. Maybe that's where the disconnect really lies. People who got burned in 2008 are conditioned to find the market expensive. Maybe we all assume that when the Fed raises rates endlessly, it will crush all stocks, like when the Fed raised rates 17 times going into the Great Recession. I'm making the case that perhaps we should just value the market as it is, with a lot of cheap big cap stocks and some expensive ones. When you do that, you don't need to fear the Fed or the tape. It's a nice, benign, and you know what? I think lucrative way to look at things. Let's go to Paul in Pennsylvania, please. Paul.
Yes, sir. I have a bunch of ADP stock, and it's been doing very, very well. And I want to know if it's time to get out of it, because I'm afraid it may take a dump.
Hey, ADP's terrific. We're not going to get rid of that stock. As a matter of fact, on any weakness, just call me a buyer of ADP, although I would do it less scatologically. All right, let's call what it is. There are a lot of cheap stocks and some expensive ones, and that's that. There's much more Mad Money ahead, including my take on a sector that you may have overlooked in the trade war tie-up. Then I'm talking with the CEO of a company that's taking a radical approach to treating mental health diseases, and I think it's going to be a very profitable one. And the utilities are picking up steam as of late, but I'm eyeing one company in the space that's declining here. Hey, what's behind that move? I'm talking to the CEO of Vistra Energy. Hey, it's one of the top 5 in the country. Stick with Cramer. We're constantly talking about the victims of this trade dispute with China. It just keeps escalating. Last time I told you to round up the usual suspects, the ones that get slammed rightly or wrongly every time tariffs are back in the headlines. Sell. But for all the chatter you hear about the industrials getting slammed because of their Chinese exposure, there is one often overlooked group that is very much in the crosshairs. The big international casino stocks like Wynn Resorts, Las Vegas Sands, and even MGM to a lesser extent. These 3 names have come down substantially from their highs, and you know what? Maybe they deserve every penny of it. In particular, Wynn and Las Vegas Sands have more exposure to Macau, the Chinese gambling haven, than they do to the United States. Yep, their China plays first and foremost. They spend fortunes building casinos in Macau. MGM has a smaller presence over there, but they just opened their second Macau property in February, and that's a $3.4 billion casino. Here's the problem. If things get really bad between the U.S. and China, then it would be the easiest thing in the world for the Chinese Communist Party to wreck these gaming companies. We often talk about the possibility of government-sponsored boycotts, but they wouldn't even need to go that far. The casino industry is highly regulated. If China wants to, you know what they can do? They can take away the gaming licenses or impose all kinds of restrictions on American-owned casinos. And hey, we're already seeing a deceleration. The overall Macau gaming numbers, I got to tell you, I found them disappointing in May, and then they were disappointing again in June. Don't get me wrong. I'm one of the few people who believes we can win this trade war, and perhaps even win it quickly. But the risk-reward with the Macau-oriented casino stocks has now become very much against you. Wynn and Las Vegas Sands get more than half of their business from China. They're hostage to the goodwill of the Chinese government. Beyond that, the Shanghai stock market's been getting killed there, which means Chinese high rollers have less money to burn at the casino. Put it all together, and the potential bear case here is a lot worse than, let's say, than for the industrials. A lot worse than I thought even, let's say, a month ago. I think Wynn and Las Vegas Sands both need to be treated as guilty until proven innocent now. MGM's tougher story. It's much more domestic-oriented and incredibly well run. I've been a big fan of the stock. If we're just judging this one based on the fundamentals, I tell you to be a buyer here, because MGM's main market is Las Vegas, and Vegas is in incredible shape. But the stock is being dumped along with Wynn and Las Vegas Sands every time there's a new flare-up with China. And, I don't think that's over, and I don't blame anyone who's just lost their patience. So I am circumspect about Wynn and LVS, and while I'd hold MGM, that's only if you're willing to be patient. But because I'm a Johnny Mercer kind of guy, accentuate the positive, eliminate the negative, let me put a positive spin on things. The global gaming companies may be too risky, but the totally domestic players, they're on fire here. The only problem is that unlike Wynn or Las Vegas Sands or MGM, these companies are not exactly household names, which is why I want to circle back to them tonight to remind you of their existence. Say hello to Boyd Gaming, Penn National Gaming, Churchill Downs, and VICI. Before I go into these one by one, let me spell out the broader thesis here. The domestic gambling bull market really boils down to two simple stories. For starters, we've got a roaring economy and a very strong consumer who can afford to burn a little money, which is why we're seeing a major uptick in gambling revenues in the places where it's legal. On top of that, a couple of months ago, the Supreme Court legalized sports gambling at the federal level. Since then, a bunch of states have legalized it too and started taking bets like Delaware and New Jersey. You don't need to overthink this one, people. Obviously, sports betting is already a huge business. It's just illicit in most places. Recently, Morgan Stanley estimated that bookies take in $7.5 billion a year. I think that's a lowball number, and they see 2/3 of that ultimately flowing to legitimate outfits. Speaking of legitimate outfits, I think it's the smaller regional gambling plays who really benefit from legalized bookmaking. They've got the existing infrastructure, and they seem to have a head start on the larger casino operations. So let's go through them one by one so you understand the importance of legalized sports betting around the country to these companies. First, there's Boyd Gaming and Penn National. They're the two leading regional players. Boyd owns 24 properties across 7 states, including a large presence in Vegas, significant exposure to the Midwest and the Deep South. Think Louisiana and Mississippi. In Vegas, this is a company that's made a name for itself catering to locals rather than tourists, although they own 3 downtown properties, the Fremont, Main Street Station, and the California. Plus, they're all over the heartland from Wichita, Kansas to Biloxi, Mississippi. More important, Boyd Gaming is a very well-run company that's making a host of small acquisitions to expand its reach, and I think it stands to be a huge winner from legalized sports betting. Next up, there's Penn National Gaming, which is like Boyd without the Vegas exposure. Just a pure play on regional gaming and racing with 29 facilities across 17 jurisdictions, from California to Massachusetts and Florida to Ontario. Now, last December, we learned that Penn National is acquiring Pinnacle Entertainment for $2.8 billion in a deal that should produce $100 million worth of run rate cost synergies. This is a huge deal for a $3.3 billion company. Even before the transaction, though, Penn National was already working hard to improve itself with a bunch of initiatives that have been boosting the company's margins. Put it all together, and I think this is exactly the kind of stock that works in an environment where the U.S. economy is red hot, but everyone's concerned about world trade. Third, this one you might know, Churchill Downs, right? It's the venue that hosts the Kentucky Derby. However, in reality, this company is more of a diversified gaming business. They own 3 more racetracks, Arlington Park in Illinois, Calder Race Course in Florida, and Fairgrounds Race Course in New Orleans. They got a casino business with 9 properties in 8 states, Mississippi, Maine, Florida, Ohio, New York, Colorado, and Maryland. Third, Churchill Downs has an online betting division, twinspires.com, as well as a horse racing research and information services business. If you want a way to play legalization of sports betting, it's hard to think of a better way to play than a company that owns horse tracks. The stock caught fire after a reported blowout quarter in April. I mean, it really was just beautiful. I think it's got more upside. Finally, let me give you another way to approach this, and this is VICI Properties. This is a real estate investment trust that was spun off heritage assets from Caesars, namely the land under the hotels and casinos and some golf courses. Hey, we just spoke to the CEO, Ed Pitoniak, that's Pitoniak, and at the end of May, and he told a good story. The stock's given us a quick 8% gain since that interview. Think of it as an arm's length way to play the industry. It's one that supports a 5% yield. I think that's terrific. Here's the bottom line. The big international casino stocks have been selling off because of their China exposure. But fortunately, we've got domestic alternatives that are doing fabulously. Boyd Gaming, Penn National, and Churchill Downs are best of breed, while VICI gives you a nice REIT alternative. Let's go to Judy in New York. Judy.
Hi, Jim. How are you?
I'm good. How about you, Judy?
Great. I'm well, thank you. Hey, Jim, I used to work for Starwood Hotels, so I have an interest